Chapter 5, Communicating and Interpreting Accounting Information. Okay, this slide shows the players in the accounting communication process. It shows the people involved in, such as the regulators, the managers, directors, auditors, information intermediaries, and users. Each person or group plays a unique role in the process. In this process, all of their decisions are based off of legal and professional standards. And they're all in there kind of as a checks and balances situation as well. If you can tell that, there's management, and then both auditors have to check in with each other, and then they also check with each other, and then they check with management in order to ensure that nothing is going on that some people don't know about. Let's talk about the regulators first. There's 4 different regulators. One is the Securities Exchange Commission. Their primary responsibility is to protect investors and maintain the integrity of the securities market. And the initials for that is the SEC, and as part of their mission, the SEC oversees the work of the Financial Accounting Standards Board, and they set the generally accepted accounting principles, which is the GAAP, which we've seen in our book. They also oversee the work of the Financial Accounting Standards Board, which is the FASB. And they set the generally accepted accounting principles. Which is the GAAP. And then, sorry, I repeated myself. The Public Company Accounting Oversight Board, PCOAB, sets auditing standards for independent auditors, which is the CPAs, of public companies and the stock exchanges. That, along with the state governments, set overall corporate government standards. The primary responsibility for the information in the financial statements and disclosure lines lies completely with management. The highest officer in management, often called the chairman or chief executive officer, which is the CEO, and the highest officer associated with the financial and accounting side of the business, often called the chief financial officer. And then underneath that, you have your accounting staff. If you read the first part of the chapter when it talks about Callaway, in their company, the CFO and the CEO must personally certify that each report that is filed with the Securities Exchange Commission does not contain any untrue information, and that it represents all of the materials and their financial condition, results of operations, and cash flows for the company. They have to oversee all of that. They also have to see that there's no significant deficiencies or material weakness in the internal controls over financial reporting. And they also have to disclose to the auditors and audit committee of the board any weaknesses in internal controls or any fraud involving management or other employees. Any executives who knowingly certify false financial reports are subject to a fine of $5 million and a 20-year prison term. The accounting staff also bear professional responsibility for their accuracy of this information, although their legal responsibility is smaller. Part of the audit committee, there's the board of directors, and they are responsible for ensuring the processes are in place for maintaining the integrity of the company's accounting financial statement, preparation, and financial reporting. The board of directors is elected by the stockholders, The audit committee of the board must be composed of non-management, independent directors with financial knowledge. It's responsible for hiring the company's independent auditors. They will meet separately with the auditors to discuss management's compliance with their financial reporting responsibilities. The SEC requires publicly traded companies to have their statements and their control systems over the financial reporting process audited by an independent registered public accounting firm. It's called an independent auditor. They have to follow the audited standards established by the PCAOB. Many privately owned companies also have their statements audited. By signing an unqualified or clean audit opinion, a CPA firm assumes that its financial responsibility for the fairness of the financial statements and related presentations. This opinion, which adds credibility to the statements. And related presentations. This opinion, which adds credibility to the statements, is often required by agreements with lenders and private investors. Subjecting the company statements to independent verification reduces the risk that the company's financial condition is misrepresented in the statements. As a result, rational investors and lenders could lower the rate of return or the interest for providing capital. And essentially, it's an outside company that's going to come in and decide whether or not what you're filing is true, so that another Enron doesn't happen, or where a company is being completely fraudulent with its financial reports. Financial analysts receive accounting reports and gather information about the company from electronic information services. They also gather information through conversations with the company's executives and visits to company facilities and competitors. The results of the analysis are combined with the analyst report. Analyst report, they normally include forecasts of future quarterly and annual earnings per share, share price, a buy, hold, or sell recommendation for the company's shares, and explanations for these judgments.